Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. In today's video, I've got 7 different companies for you that have a wide economic moat. I'll explain what that means in a second. They have increased their dividends, so they all pay dividends, and they have increased their 5-year growth rate is about 10% or more. Okay, and they are all undervalued at the moment. Before I get to that, I just want to say one thing, and that is just like the video, subscribe to the channel if you haven't already, and obviously share with your family and friends and everyone that you think will benefit, inshallah. And obviously definitely join us on the Discord, join us on the Patreon first, and join us on the Discord. It really helps the channel if you can. And obviously you get access to all the spreadsheets that I use on my on daily basis, and you can actually get, obviously like I said, access to the private Discord where you hopefully will meet brothers and sisters who are like-minded. That's what we're trying to build. Okay, community of like-minded people who want to basically spend their money the halal way, and obviously buy companies that are profitable and not just some sort of speculative penny stocks and so on. So that's the plan, inshallah. So first thing I want to talk about is the Morningstar rating. So one of the things that we always talk about here is the moat rating, and this comes from Morningstar. And Morningstar basically says by using their moat rating, okay, the investors basically will get a superior long-term returns. And I kind of agree with them, because if you think about the moat situation is, okay, so there are 5 different things they look for. They look for basically something called switching costs, basically are becoming basically an obstacle for customers, from changing from one product to another. So if you use Microsoft, so for example package, it's very difficult to change to another one. If you use Apple, for example, it's very difficult to change. If you buy your toothpaste from here, it is very difficult to change. So that is one of the things companies get a moat ratings of Wide Moat, for example. Okay, the other one is the network effects, and that occurs when the value of a good or service increases for both new and existing customers more than people use that basic good and services. Then you also have intangible assets. You've got the companies with intangible assets, basically are things that such as patent, government license, brand identity, and so on. You also have a company with cost advantage. Okay, that basically they can actually increase their costs and nothing, basic customer will still pay for it. Look at Apple, for example. Every couple of years they release a new phone, they give a different name, they just change a couple of things here and there, and before you know, everybody's buying it for $1,200, $1,500, whatever it is. So all of these things are really important to us as investors, and should be important to us, because you want to own companies that have a wide economic moat. And the reason I say that is because if your company, if we're in a recession and the company has a pricing power, for example, they can increase the price knowing that their customers will pay for it. Okay, we also need to know see companies that have increased their dividends basically in the last 5 years, maybe 10%. Normally I look for about 6%, but 10% or more is really good. And obviously you don't want to overspend, and that's another thing that we need to look at. Now, one of the things I want to talk about first of all is basically where we are now in the when it comes to the general stock market. So we've got the Dow Jones, okay, that is flat for the year, so literally just less than 1%, 0.5%. So it's flat, basically. It hasn't done much. If you had, for example, if you bought the indices, okay, the Dow Jones Industrial Average Index, for example, the ETF that tracks this, you probably right now have made absolutely nothing. Okay, if we look at the SPY, okay, which is the S&P 500, right, a year to date, you'll be up nice, almost 10%, which is very good. This is what the S&P 500 returns anyway, on average 8% or more. Okay, so you will be up about 10%, which is quite nice, right? And then you look at the Nasdaq, 26%, almost to 27% a year to date. So now, if you want to look at the QQQ or just look at Nasdaq, there's all the tech companies, all the new stuff, all the AI companies, every single one of them is in there. And you really have to be careful about some of these companies. Some of them are really good companies. They have a free cash flow that's nice. They're growing revenues like crazy. They have products that are needed, like the Nvidias of this world and so on. great companies, but their valuation is really, really high. And if we end up in a recession and the economy slows down, these are the type of companies, and interest rates keep going up. These are the companies that will be affected. I don't need to tell you what happened in 2022, where we got the shock, basically the fact that the Nasdaq was down so much and everything else was going up. The dividend companies were the ones that were basically holding up really well in comparison to the Nasdaq, for example. So please be patient, be careful. Okay, don't follow those hypes. Like I was talking to one of my mates and he's telling me about these penny stocks that are going to the moon every single day, and he's checking it, he's investing in it and so on. Please don't touch those things. Be careful. Okay, be conservative. That's all I'm doing. Everything you see in here, there's no one single company that is very speculative in my portfolio. Even if it was, I wouldn't make it more than 1%. I used to have Tesla. I made a lot of money selling Tesla and so on, right? But that used to be about 2% of my portfolio, 3%. Maximum was about 4% at one point. And then I kept selling it. It kept going up. I kept selling it. It kept going up. And then at the end, I had 2 shares I didn't know what to do with, and I sold it. I made almost closer to £3,000, if not more. It's just basically selling that stock. So just be careful. If you basically investing in speculative companies, maybe just make it 1% of your overall portfolio. The rest of them should be quality companies, like the ones that we're going to talk about now. Okay, so there are 7 companies. They're all undervalued right now, and the 3 things we're going to focus on is wide economic moat, the 5-year growth rate in terms of dividend, and then Morningstar valuation. So first one is Visa, $477 billion market cap, has a wide economic moat, $232 per share. Dividend is not that great, but it's actually increasing. So the latest increase was 21%. Basically the 5-year growth rate is actually 20%, which is really huge. But the payout ratio only 18%. So they can increase that dividend if they need to. And then dividend growth history of basically 14 years. So they have increased that for 14 years. $1.08 is what you get. 99% safety, profit margin 50%, return on equity 45%. Look at how amazing that is. And look at the free cash flow here. This is the type of business that you should be looking at. It has a basically wide economic moat. They have excellent free cash flow. Basically, they're giving back a lot of money to their shareholders in terms of buybacks, in terms of dividends and so on. And they are expected to grow next couple of years. Okay, next 5 years at least based on this analyst, right? And 4% discount right now. $241 per share is where it should be. The next one is Nike. Nike, you know, obviously, this company, I'm sure you're wearing their trainers and so on. They also have a wide economic moat, okay? They are a huge company, $180 billion market cap. Dividend is not that big either, but again, it's growing. 11%, basically latest increase, 11% the 5-year growth rate. Again, 36% payout ratio, okay? Which is really low if you think about it, okay? Once it gets to 50s, that's when you start, or even 60s, 61 is a buffer on this when you start worrying about these kind of companies, unlike the REITs, right? So again, 20 years of increasing that dividend. And then you get a nice $1.36 for every dollar you own, basically every share of this company that you own. 99% safety, 10% profit margin of 10%, return on equity 36%, free cash flow about 3.8 billion. I'm actually a little bit surprised that they don't have that much of a cash. Maybe they have so much inventory, like recently the company is struggling to sell all the products or whatever. But total return in the last 10 years, we look about 14%. Growth in next year is expected 25%, then 9% growth every year after that, and 16% discount. $138 per share is where the price should be. Next company is Automatic Data Processing, is another company that is monopolized the market. It's in $88 billion market cap, obviously wide economic moat. The dividend is actually quite nice, 2.34, and the latest increase was 20%, and the 5-year growth rate of 13%, absolutely huge. 58% in terms of payout ratio, which is a little bit high, but is not. They still have room to improve if they need to, and they have increased that dividend for 47 years. So soon this company will become a dividend king, and that's a company that has increased its dividend for 50 years or more, but they are dividend aristocrat. You get $5 for every share of this company that you own. Safety is 97%, profit margin 18%, total there's a return on equity 104%, and $3.36 billion of basically free cash flow right now. Total return in the last 10 years, we're looking at about 13.5%. They're expecting 9% growth next year, and then 13% after that, almost 14%. 7% discounted right now. $228 per share is where the price should be. Right now, it's only $213, which is good. Next one is MasterCard. Okay, is again $360 billion market cap, has a wide economic moat. Dividend is actually not basically huge, but it is actually is same as basically Visa. 20% increase, basically latest one. 16% in the last 5 years, and the payout is very low. You get $2.28 for every share that you own. 99% safety, which is the highest you can get. They have excellent profit margin, return on equity. They have $10 billion in the bank. Total return in the last 10 years. Although it doesn't mean this is what's going to happen next 10 years, right? But at least it gives us an idea. This is a profitable business, right? Growth estimate for the next basically year, they're expecting about almost 19%, then 20% after that every single year. 2% discount right now. $389 per share is where the price should be. I really like MasterCard. Okay, I own Visa, but MasterCard is another company that I actually used to own before, and I sold it because it was at the time the markets were going down, and I didn't want to own two companies that are very similar and basically in the same sector. If anything happens, they both go down, and they were going down. They were equally going down 2%, 3% every single day. So that's why I thought, you know what, let me take some profit and sold it. The next company is Intuit. This company is a really interesting company. Okay, they basically work with a lot of small businesses. They have a lot of software these companies use for their basically payment and so on. 121 taxes, basically they do a lot of the taxes side of things. I think there's a software called TurboTax, and I think they use that in the US. 121 billion market cap, wide economic moat, and the dividend is not that much, but latest increase was 23%, and the 5-year growth rate of 15%. Only 15% payout ratio, and they have increased that for 10 years, and they will give you $3.12 for every share of this company that you own. By the way, I do have a full video coming up on this company in the next couple of days, if possibly tomorrow, if not after that. So safety is 98%, 14% profit margin, and then return on equity, we're looking about 12%. Free cash flow, looking at about $4 billion, which is really good. And then last 10 years, they've actually returned 22% to their shareholders. This total return includes the dividend as well as obviously price appreciation. Next year, they're expecting almost 13% growth in terms of earnings, 15% after that every single year, 16% discount right now, $503 per share. This is really interesting company. I mean, if I didn't have a lot of technology companies in my portfolio, I would probably look into this. And maybe instead of buying companies like Salesforce, this will probably be a better company. Again, we'll dig deeper next video or the video after, and we'll see how that goes. The next company is one that I own, that's S&P Global. You probably heard me talk about this company so many times. It definitely has a wide economic moat. It's $116 billion market cap. They monopolized, this company and Moody's have monopolized the markets. Okay, between the two of them, they deal with every single company out there, every single country, every single bank in terms of ratings, in terms of credit and all of that stuff. Okay. Dividend yield just 1%. Latest increase only about 6%, but 15% growth in terms of 5-year growth in the last 5 years. 30% payout ratio right now. Okay, so that means they have a massive. If they want to increase this, they can do as much as they want to, and they are dividend. They're going to be dividend king. Hopefully by the end of this year. $3.60 is what you will get. 99% safety, profit margin of 23%, return on equity about 7%, free cash flow $2.87 billion. I would want to see more of this, okay, maybe about in the $5 billion, because this company does not spend a lot of money in terms of basically in spending money, basically. Okay, they keep a lot of their revenue, so hopefully in terms of net income, I would love to see this increase in year after year in the next 5 years, hopefully. And then total return 21% in the last 10 years, 15% in terms of growth for next year, and then 13% after that, which is really good. 3% discounted right now, $370 per share. This is really quality business, I'll be honest with you. And the next one is Moody's. Okay, you can't talk about one without talking about the other, because they're both actually discounted right now. They are both wide economic moat, both increasing their dividend as well. So they're very, very similar by looking at this information. But Moody's has not increased its dividend, okay, more than 13 years. So only 13 years, they pay around the same amount in terms of dollar amount, and in terms of dividends. Payout ratio, this one has got 83%. In terms of return on equity, actually, Moody's is apparently better. Free cash flow $1.32 billion, which is not bad at all. Again, I would love to see that increase. 17% total return in the last 10 years, so it's actually not bad. 4% less than what S&P Global has done. Now, next year they're expecting the earnings to grow up almost 14%, then 12% after that. 2% discounted right now, $315 per share is basically where it should be. Right now, I'll be honest with you, I would love to own this company, but I don't think I would want to own both of them. Again, the same reason that I don't want to own MasterCard and Visa at the same time. These four companies, basically, these two are exactly identical in terms of business they do. I prefer S&P Global because of obviously the dividends, because of as well as the free cash flow and so on. At the same time, Visa I think is a great company. I absolutely love it. I want to increase my overall how many shares I own right now. I've been doing that in the last few days, last few weeks, and I'm going to continue doing that. Just right now is the fact it's actually 4% discounted. If there's a pullback, hopefully in the next few weeks, then I will add more to it. I want to own at least 5% of my portfolio to be Visa, inshallah. MasterCard, I'm considering adding to the family portfolio. It still is the same exposure anyway, but the family portfolio, there's not that many tech companies right now, so I'm looking at adding this company. By the way, before I get asked the question, both companies do not deal with any riba, any basically interest and anything like that. These companies are technology companies. They provide the technology behind what we basically did, was in these cards. So there you have it. You've got 5 to 7 different companies that are absolutely amazing. Wide economic mode, and dividend increasing, all basically undervalued at the moment. So if you're looking for quality companies, and you don't want to, obviously, you want to sleep well at night knowing that you own some quality businesses, then obviously go for these companies. I own Visa, I own S&P Global, so just to be transparent. What else have I talked about that I own in this portfolio? I think that's about it. Those are the two main. Iron Air Producting. Automatic data processing is also the third company that I own that we've talked about today. The rest of these companies I do not own. I'll be doing a full video on this one, inshallah, very, very soon. Let me know if there's any specific companies you want me to look at, either in the S&P 500. I'm talking about quality companies, not some speculative companies. Inshallah. Have a wonderful day. Assalamu Alaikum.